Hello everybody, it's Ben Kumar and Tom Sheridan from 7 Investment Management. We're here just on the back of our recent discussion about the Q4 asset allocation, and the real question that all those long discussions boil down to is really, are we at an inflection point? Are we beginning to look at the end of QE? And that conversation has sort of 4 subdivisions. One was the macroeconomic picture of the world versus what global markets are doing. The second one is, what are the central bankers thinking and doing, and what is their and indeed our view of inflation? The third one, which relates from which carries on from the first two, is currencies and the impact on currencies. Then, of course, we have the ever-present tail risks in the world. So, Ben, to begin the tail of the 4, if you will, paint the picture of the global economic picture for us.
So, the global macroeconomic picture is average, and that's a good thing. We're at about average levels of GDP growth, and it's kind of synchronized. You've got growth coming in China at around 6%, so lower than previously, but still pretty good. In the US, growth a little bit weaker than expected, but that's counterbalanced by Europe, growing at 2%, which is about the highest we've seen Europe grow in nearly 2 decades.
So, current growth around the world is pretty well synchronized. There's no part of the world which is really having a horrible time. And we have seen markets do what on the back of that?
Well, look, markets have been appreciating for a long, long time. The US has been in a bull market now for 8 or 9 years. And that means valuations have crept up. When we talk about valuations, we look at something called the price earnings multiple. It's where you look at a company's earnings, work out what you multiply it by to get to the share price. And if you look versus the long-term average, most markets today are trading a little bit expensive. Valuations are a little bit above the long-term average. So it's just saying that markets have run on a bit. Markets saying things are good, global growth saying things are average.
So that's the equity markets, where we're saying valuations are looking a little bit rich, or certainly a little bit higher than they have been over the long run. Other asset classes, fixed income, for example.
Well, fixed income has had a fantastic time really since quantitative easing began after the financial crisis. Yields are still incredibly low. And that worries us slightly. Again, it looks a little bit expensive as an asset class.
So if we take those expensive markets and we look at what the central bankers are looking at right now, they have been pumping unbelievable amounts of money into economies, and as you just said, with the resultant low interest rates. What are they thinking now? What are they likely to do next?
So central bankers are clearly talking at the ECB, the Federal Reserve, even here in the UK, about interest rate rises coming through, or at least the taps being turned off. No more money being pumped into the markets. I think that's on the back of their concerns about inflation.
So if we're looking at central bankers raising interest rates, then arguably low interest rates have had something to do with the equity valuations. I mean, we probably have seen over the last little bit dividend yields higher than the long-term bond yields. And that happens every once in a while, but not very often. Are we looking at central bankers now reversing that situation? And if so, what do we think the implications of that would be?
Well, it's absolutely right. People have been forced into the equity market to look for yield, to look for income. Now, when interest rates do start to go up, we know that's bad for bonds. That's built into the DNA of what a bond does. But it could be bad for equities as well, as people just panic about asset price inflation and decide to step back from the markets altogether.
So if the reason for the rate rises is very, very robust economic activity, that's fine. But if they're raising rates because it's time to raise rates and we have sluggish economic activity, that might not be so fine.
Exactly.
So Ben, normally when central bankers are thinking about raising interest rates, it's very often with the backdrop of rising inflation. But we really haven't seen inflation, have we?
Well, we have seen inflation in asset prices. If you think about the financial markets, we talked about equity markets going up in a bull run, same for bonds, same for most financial assets out there. So central bankers are a little bit worried about that, and they're a little bit worried about wage growth starting to come through, particularly in the US, but over in Europe as well. When wage inflation starts coming, then central bankers really do start to look to raise rates.
So therefore the central bankers actually think we're looking at the prospect of rising wages.
When unemployment gets as low as it is now, companies eventually start having to pay their employees more. And that, I think, is the situation we find ourselves in.
Okay, so just a quick recap on what we're looking at. we've had economic conditions pretty benign around the world, getting a little bit better in Europe than they have been, in particular. We're looking at valuations which have been very stretched in most asset classes, in particular fixed income and equities. We're looking at central bankers in the face of this, possibly looking at reining in quantitative easing and raising rates. And that leaves us, of course, with the question of how is it that we're going to reach the expected returns that we promise our portfolios over the longer term and still protect capital against unforeseen tail events. What are we looking at when it comes to portfolio positioning? Why don't we start out with equities?
In the equity market, we've already talked about how the valuations are looking a little bit expensive. There's one area where that's not the case, and that's in Europe. In European equities, you've got strong growth and you've got reasonable valuations. So we're overweight there. The rest of the portfolio, though, in the UK and the US in particular, where things look expensive, we're underweight, which leaves us underweight equities overall.
So in a balanced portfolio, we would normally have about 48% in equities, and now we've got on the order of 38% in equities?
Exactly right.
Okay. And in fixed income, we've been underweight for the last couple of quarters. Still?
Still underweight fixed income. It's those interest rate rises, that, again, we've mentioned, that worry us. So we have a zero allocation to gilts, the UK government bonds, and we have an underweight to most of the rest of the fixed income portfolio.
So again, to put some context on that, normal allocations, 36, 38% in fixed income, about 10% below that?
Roughly 10% underweight, exactly.
So between equities and fixed interest, we're about 20% under the weightings that we would consider to be normal. Where's the money going?
Well, so the bulk of the money has gone into the alternatives portfolio, something we've been talking about for a while, but in particular, market neutral strategies. Now, these are strategies, a basket of them, we've created that should have low correlation to fixed income and low correlation to equities and deliver a stable return at low volatility throughout the course of the year.
So that's what they're supposed to be doing. What are they doing?
Well, we've seen them perform exactly as we've expected this year. The basket of them up around 2–2.5%, and all the while the gilts return has been about zero.
Right, so the basket of alternative investments collectively taking the place that gilts would normally hold in the portfolio, and indeed that's why we have them there.
Indeed, and a little bit now as well, taking the place of equities, which also look expensive.
And hence the term market neutral.
Exactly.
Now, equities, fixed interest, alternatives. Let's talk about currencies for a minute. We've seen currencies take front and center for much of the last year and a half in portfolio management. Where have we recently been and what are we doing about it now?
The situation for UK investors is, of course, to think about sterling. Now, in the past 18 months, we've seen sterling at $1.50, we've seen it at $1.20, and we sit today at about $1.35, so right in the middle. Do we know where it's going? To be frank, no. The political situation with Brexit is incredibly uncertain. So what we've tried to do is position the portfolio so that regardless of a rise in sterling from here or a fall in sterling from here, the portfolio should be reasonably well protected.
So how do you actually do that?
It means keeping a chunk of the portfolio in foreign currency. We have about 30% of the balanced portfolio in foreign currency, which should do well if sterling falls.
Dollars, euro, yen, Swiss franc, those type of things?
Yeah, a mixture of all of them, right? All the foreign currencies. You're not trying to look at what any individual foreign currency is doing. You're looking at sterling. Yet at the same time, we're aware that if sterling rallies, that will cause those foreign currencies to fall in value. So we've purchased a few options. Now these should do well if sterling rallies. These are call options which we hold in the portfolio.
Isn't that an expensive way to buy insurance?
Usually it is. Portfolio protection costs, like it does with house insurance. You pay up your premium and then usually, you hope, you don't have to use it. But with volatility at all-time lows, buying those call options has been reasonably cheap. And so as we've been given that opportunity, we've picked up this protection, which should help out the portfolios.
So with all the overpriced assets in the world, courtesy of quantitative easing, we've actually found something in the world which is lower than it normally is, and that is volatility. And as Ben has just described, being able to use the low cost of volatility to buy portfolio protection from a currency perspective seemed to us like a perfectly rational thing to do right now. Not least because there are tail risks in the world. And when we say tail risks, we're talking about low probability but high impact events, such as?
So the North Korean situation immediately springs to mind. You've also got things like cyber attacks, we've been seeing increasing frequency. But to be honest with you, it's really the things you don't see coming, that you and I won't talk about, that come out of nowhere.
As my fellow Americans say, those unknown unknowns. But given that we have such a volatile political environment, we must account for those unknown unknowns in the portfolio. How are we doing that?
So we have a large allocation to gold, the largest 7IM's ever had. We also have a position in the US Treasury market, which is still the ultimate safe haven asset. And then lastly, we have cash. We have a cash weighting that's nearly double our neutral position in order to take advantage of any opportunities to invest in assets as they become cheaper.
So in a balanced portfolio, that's about?
10% in cash versus a neutral of about 5%.
Okay. Well, Ben, that's been a really, really helpful recap. In summary, what we've done is we're looking at the world, which appears from an economic standpoint to be benign. And so it is possible that equities continue to roll forward for the next little bit, and your customers will benefit from that. At the same time, it's possible that the beginning of the end of QE has a more negative impact on markets. And we're also taking account of that with our lower fixed income position, with our alternatives, and indeed with the currency positions and the treasuries and the cash. In the round, we think that's the most sensible way to manage money to achieve the expected returns that you're looking for over the medium to long run, and also to mitigate against the downside risks. Ben, thank you again, and we'll see you in 3 months, and we'll see what it looks like then.